If you have ever watched a winning trade turn into a massive loss because you panicked, you likely blamed your own lack of willpower. But the reality is much more mechanical. Human biology actively sabotages trading success. We are fighting millions of years of evolutionary wiring. Looking closely at these deep subcortical structures, we see the physical root of greed. According to the anticipatory affect model, the prospect of financial gain activates a specific region called the nucleus accumbens. This creates intense positive arousal, driving us to approach risk. This diagram shows what happens when the market turns volatile. The threat of a loss triggers an entirely different pathway, firing up the anterior insula. This generates immediate negative arousal, panic, and an overwhelming biological urge to avoid the pain by abandoning the trade entirely. To bypass these biological traps, you need to build a structure that offloads the decision-making. Open a blank document or grab a notebook. We are going to build a 3-part Neuro-Psych Trading Framework. Simply understanding the psychology will not save your portfolio. Under extreme stress, the anterior insula hijacks your cognitive processing. You must rely on a written, mechanical framework to dictate your actions when your brain goes into survival mode. Write pre-trade checklist at the top of your document. Your first mandatory checkbox is confirming the presence of an objective trading edge. You must define the specific criteria that prompt an entry, with zero room for guessing or intuition. Add a second checkbox. Limit risk to exactly 1 to 2% of your total trading capital per trade. Keeping your exposure this low is the ultimate regulator of your emotional response. A 1% loss rarely triggers panic. This chart shows a simulated sequence of wins and losses based on a fixed probability. As Mark Douglas established, any individual trade is entirely random. You can suffer 6 red losses in a row, yet still see your equity curve rise over the long term. You do not need to know what happens next to make money, provided your mathematical advantage is present. That brings us to your third checkbox: complete, absolute acceptance of your predefined risk before you execute the order. You can physically test for this acceptance. If you are hovering over the buy button and your heart rate elevates or your chest tightens, your brain is treating the trade as a physical threat. You have not accepted the risk. You must reduce your position size until your body relaxes. Physically checking these 3 boxes ensures that a potential loss will not trigger an emotional spiral. By defining and accepting the worst-case scenario up front, you keep yourself out of the biological fear zone. Now create a section titled The In-Trade Environment. The actions here require you to change your trading software settings before the market even opens. Your first mandatory action is configuring hard, automated take-profit and stop-loss orders immediately upon entry. The platform must manage the exit, so you don't have to manually execute it while under pressure. Next, go into your platform settings and completely hide the live profit and loss ticker. Staring at a fluctuating P&L is the single largest trigger for the anterior insula. Watching your open equity bounce up and down overloads your brain with conflicting signals of reward and threat, leading directly to premature exits or reckless revenge trading. The core disciplinary rule of this phase is simple. Professionals trade the objective chart setup. They do not trade the emotional feedback loop of a live P&L. Let your preset orders do the work. Create your final section, the post-trade review. Build a table featuring 3 distinct columns: trade setup, emotional state prior to entry, and action taken. The emotional state column is where you track feelings like anxiety, hesitation, or overconfidence. Documenting this state before you click buy helps you identify the specific behavioral triggers that lead to poor execution. In the action taken column, you must explicitly confess if you deviated from your plan. If you manually widened a stop loss or closed a position early out of fear, write it down. That brings us to the final non-negotiable element of the entire framework, the 3-strike rule. If you log 3 consecutive losses in a single session, no matter how small they are, you are done for the day. You must step away and shut the trading platform down entirely. This physical cutoff is a required circuit breaker. It mechanically stops the cycle of revenge trading before your brain's emotional centers can fully override your logic. You now possess a tangible physical tool to manage the entire life cycle of a trade. The pre-trade, in-trade, and post-trade rules are all securely in place. It is time to shift your psychological definition of a winning trade. A successful trade is no longer one that makes money. A successful trade is one where you executed this checklist flawlessly. An edge is only a mathematical indication of a higher probability. That advantage only reveals itself over a large sample size of emotionless, systematic executions. Your challenge is to print this checklist and use it strictly for your next 20 trades. Do not alter a single variable. Just follow the rules exactly as written. Long-term survival in financial markets does not come from predicting the future. It comes from implementing the rigid structure required to master your own mind.